Okay, welcome to Stock Talk with Nico Kritikos. Today we are going to be going over my bullish thesis on Zillow stock. And if you don't know, this is the top real estate website in the United States, and they operate with buying, selling, renting, and financing homes. As you can see here, they did $1.3 billion of revenue this past quarter, Q2 2021. And their average monthly unique users is 229 million. So they also have 135 million homes in their database. So those are some great numbers. Now, first up on the list, we're going to check do they have net income growth over the past? Well, first, let me get out of the way. I do own 19 shares at an average cost of $86. I just bought this a couple weeks ago, and I'm already up 22%. I kind of regret not buying more. I should have bought way more shares, but I didn't. So if it comes back down under 100, I'll probably buy a couple more shares. But I do have a small position in this. Now we can go to the net income. We can see no, they have not had any net income growth. Their earnings have been negative since the company started, and they have not had any profitable years. So this gets a no. Revenue growth, yes, they've had huge revenue growth, especially in 2019, 2020. They put up great numbers, so that gets a yes. Is the stock down? This is, I guess you can consider this a large cap because it is 20-something billion dollars. So we can call this a large cap. And from its highs of over $200 a share, it is down pretty big. So yes, it is a stock that's down. I mean, you still have to remember, though, that it was at such a big valuation. It was trading at over a $50 billion valuation, which is extremely high for a company that's not even profitable. But that's just the way it is. Next up, return on capital and return on equity. If we check those numbers, we can see that their return on capital is 7%, not the best. Return on equity of 2.9%, also not the best. So that's going to get a no. Is the company innovative? Yes, very much so. Smart. Is the management team good? And is it founder-led? It is founder-led by this guy named Rich Barton. He was a co-founder since 2004. And he's done a good job with growing revenue, but the company is still not profitable. So there's a bit of a issue there. And then I watched this interview with him, and it seems like he knows what he's talking about, but we will see. So we're going to give that a yes because it is founder-led. That's always a plus. Healthy profit margins? No, they're not profitable. Healthy free cash flow. We can go look at their free cash flow right here. And as you can see, operating cash flow, not the best. You can see this past year they lost a lot of money. And so that's a no. Is the industry growing? Yes, it is. A low forward PE, not exactly, because if we look at the PE, well, they don't really have a PE because they're expected to make, let's see, when are they expected to make a profit? So next, for this year, they're expected to do $1.16 of EPS, and then next year $1.14 because the housing market's probably going to die down. Some of the bad news that we've heard recently is around over 65% of the houses they own in some big cities like Phoenix and Atlanta, they have been selling them for a loss around 20% less, 15% less than what they paid for the house. So that is bad news. However, in the short term, that is going to hurt them for the next 6 months or so. But long term, I'm a believer in this company. So low forward PE has a PE of 70, which is lower than where it's been in the past. And you got to consider, how much is this company going to grow in the future? They're expected to do 95% revenue growth this year, 42% growth next year. This is a very fast growing company. So you can make an argument that is actually a cheap PE based off how much growth they have. Now, if we compare them to their competitors, let's see what Redfin trades at. Redfin is a little bit smaller of a company, but they don't have a forward PE. And then we can even look at, what's the other one? Open Door. Open Door trades at, once again, no forward PE. So these companies are even further behind because they're not expected to make a profit for a couple more years. So, but we can give that one a yes, because you can definitely make a case that those earnings are going to grow quick enough. Long-term assets to long-term liabilities. Let's check that. Okay, we're going to go to the most recent quarter. Current assets 6.2, current liabilities 1.6. That's good. Long-term assets 2.4, long-term liabilities 1.6. Both of those are healthy. So that gets a yes, and this gets a yes. We should probably share buyback. No, I have a feeling this number is not going to look too good. Yeah, over the past year, they've increased the number of shares by 13%. That is not what we are looking for. That's a no. Hedge fund, big investors or insiders buying. Well, we can find that information here. So insiders have been selling a lot, starting at $20 a share. They've been selling, and they sold at $100 a share. So not the best, but we picked up our shares in the 80s. So that's cheaper than it's been. Hedge funds, not really. Hedge funds have not been increasing too much. So that's going to get a no. Increasing equity. Let's see. So they've gone from 4.3 billion a year ago to now 5.6 billion. That's healthy as well on a yearly. Over the past couple of years, they did the same. So that's a yes. Diverse revenue streams. Yes, because they are operating in so many different markets, so many different cities. They make money in so many different ways. Not a ton of ways, but they can, there's room for them to expand. They're still an innovative company, and they make money from selling homes, from taking fees out from people who are using their platform. And so that one, I feel pretty confident with that. So how many yeses do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's not a good sign. That means this checklist is supposed to be 12 out of 16. It's a buy, and this one's only 10 out of 16. So technically this would not be a buy, but I don't know. That's why you really gotta watch this one, because if they can, once they report a profit, it'll definitely be a buy. And if they stop increasing the amount of shares on the market, that will also help. But there's a lot in here that is just based off of, cash flow, profit margins, return on capital, return on equity. And I mean, they haven't shown any improvement in profitability. So that's the problem there. But I'm still a believer in this company long term. And I just think the technology is not going anywhere. So I have a little position, and if it falls back into the 90s, I'll probably buy a couple more shares. But I'm curious to see, what do you guys think? Let me know down below if you guys are buying.